Most traders believe the market is the problem. They believe the chart is against them. They believe losses come from bad entries, bad timing, or bad luck. That belief is the first illusion. The market is not doing anything to you. It is not rewarding you. It is not punishing you. The market is simply offering information, moment by moment, within a probabilistic environment. What you experience emotionally in that environment has nothing to do with price and everything to do with you. Trading is a mirror. It reflects your beliefs about uncertainty. It reflects your relationship with risk. It reflects how much you trust yourself or don't. It reflects whether you need to be right or whether you understand probabilities. And here's the part most traders avoid. The market will expose every unresolved fear, every hidden expectation, and every illusion of control you carry, without mercy. You don't fail in trading because the market is hard. You fail because the market shows you who you are before you are ready to see it. The trader who survives doesn't fight the mirror. They don't argue with it. They don't try to control what it shows. They face it. And when you finally face what the mirror reveals, trading stops being a battle and becomes a discipline. Most traders enter the market believing that success comes from control. Control over entries, control over exits, control over timing, control over outcomes, even if they never say it out loud. The assumption is there: if I do the right analysis, if I read the chart correctly, if I wait for the perfect setup, the market should cooperate. That belief is invisible at first. It feels logical. It feels responsible. It feels like preparation. But the market has a way of exposing beliefs, not through words, but through experience. The moment price moves against a perfectly reasoned trade, something inside tightens. The moment a trade fails after everything looked right, frustration appears. That emotional response is not caused by the loss itself. It is caused by the collision between expectation and reality. The market does not respond to effort, intelligence, or intention. It responds to order, flow, liquidity, and probability. When traders feel betrayed by a losing trade, it reveals an unexamined belief that correct thinking should lead to predictable outcomes. This belief creates an illusion of control that feels comforting but is fundamentally incompatible with how markets function. In a probabilistic environment, no single outcome can be controlled. You can control risk. You can control execution. You can control consistency of behavior. But you cannot control what the next trade will do. The market makes this fact unavoidable. Every time price moves in a way that contradicts expectation, it holds up a mirror and shows the trader how deeply they still believe they should be in charge of outcomes. Many traders respond to this discomfort by trying to regain control. They add indicators. They refine entries. They look for confirmation. They widen stops. They tighten stops. They interfere with trades mid-execution. These behaviors are not strategic improvements. They are psychological reactions to uncertainty. The mirror is showing fear, and the trader is attempting to escape it. Control, in the way most traders understand it, is about avoiding emotional pain. Losses feel painful not because money is lost, but because the loss challenges identity. It suggests incompetence. It triggers doubt. It threatens self-image. The desire to control the market is really a desire to protect the self from these internal experiences. This is why two traders can take the same loss and have completely different reactions. One accepts it calmly and moves on. The other spirals into frustration, revenge trading, or paralysis. The difference is not the trade. It is the belief structure each trader brings into the experience. One understands that losses are an inherent cost of doing business in a probabilistic environment. The other believes losses mean something about them. The market reveals this difference relentlessly. It does not adjust its behavior to accommodate comfort. It does not soften outcomes to protect confidence. It simply presents opportunities and outcomes again and again, until the trader either adapts or leaves. True control in trading does not come from influencing the market. It comes from relinquishing the need to influence it. This is one of the most difficult transitions a trader must make. Letting go of control feels like giving up responsibility, but it is the opposite. It is taking responsibility for what is actually controllable. When a trader accepts that they cannot control outcomes, they stop trying to manage the market and start managing themselves. They define risk before entering a trade and accept that risk completely. They execute their plan without hesitation or interference. They allow the trade to reach its natural conclusion. In doing so, they remove emotional resistance. Emotional resistance is the hidden force behind most trading errors. It shows up as hesitation, overtrading, premature exits, and moving stops. Each of these behaviors is an attempt to regain control in a situation where control does not exist. The mirror is not showing market chaos, it is showing internal conflict. The trader who understands this begins to see losses differently. A loss is no longer a failure of analysis or a personal mistake. It is simply one outcome in a series of outcomes governed by probability. This shift does not happen intellectually first. It happens emotional, through repeated exposure to uncertainty without attempting to escape it. At first, the urge to intervene is strong. The mind looks for ways to avoid discomfort. But each time the trader allows a trade to play out without interference, they weaken the belief that control over outcomes is necessary for safety. Over time, trust replaces fear. Not trust in the market, but trust in oneself to follow rules regardless of outcome. This is where consistency begins. Not when a strategy is perfected, but when the trader no longer needs the market to behave in a certain way to feel okay. When the outcome of any single trade becomes emotionally irrelevant, execution becomes effortless. The market continues to do what it has always done, move unpredictably. But the trader's experience changes completely. There is no longer a struggle between expectation and reality. There is alignment. The mirror still reflects, but what it reflects is different. Instead of fear, it reflects acceptance. Instead of frustration, it reflects neutrality. Instead of the need for control, it reflects confidence rooted in process rather than outcome. This transformation does not come from motivation or discipline alone. It comes from a deep internal realization that the market does not exist to confirm beliefs, reward effort, or validate identity. It exists as a probabilistic system that offers opportunity without obligation. When a trader truly understands this, they stop asking the market to give them something. They stop demanding certainty. They stop resisting losses. They stop trying to be right. They execute. That execution, free from the illusion of control, they find the only form of control that has ever mattered, the ability to remain consistent in an environment where consistency is not guaranteed. That is what the market reveals to anyone willing to look honestly. Not how to predict the future, but how much of their past thinking still stands in the way of mastering the present. The market does not teach this gently. It teaches it repeatedly, through experience, until the trader either lets go or keeps fighting a battle that cannot be won. The mirror is always there. The only question is whether the trader is willing to face what it shows and release the belief that control was ever the goal in the first place. Most traders believe that emotions are the enemy. They think fear ruins trades, greed causes mistakes, and confidence disappears at the worst possible moment. So they try to suppress emotion, ignore it, or overpower it with discipline. But emotion is not the problem. Emotion is the signal. And until a trader understands that, the market will continue to feel confusing, personal, and hostile. Price moves are neutral. Candles have no intention. The chart does not know you exist. Yet inside the trader, each movement can feel loaded with meaning. Anxiety before entry, relief after exit, frustration after a loss, excitement after a win. These reactions are not random. They are structured responses driven by belief systems that operate beneath conscious awareness. That internal response is the real chart, and it is the only chart that truly explains why traders behave the way they do. Every emotional reaction is evidence of a belief encountering uncertainty. When fear appears, it is not because the trade is dangerous, it is because the trader believes that losing is unacceptable or threatening. When hesitation appears, it is not because the setup is unclear, it is because the trader does not fully trust their edge or themselves. When overconfidence appears, it is not because the market is generous, it is because the trader is attaching meaning to short-term success. The market simply provides the stimulus. The emotional response reveals the interpretation. Most traders never examine this. They treat emotions as obstacles to overcome rather than information to understand. As a result, they repeat the same patterns over and over, convinced the problem is external. But if two traders take the same trade and experience completely different emotional states, the difference cannot be the market. It must be internal. This is why emotional reactions are more valuable than any indicator. They tell you exactly where your belief system is misaligned with the reality of probabilistic trading. Fear shows where risk has not been accepted. Anger shows where expectations were unrealistic. Euphoria shows where identity has become IED to outcome. Regret shows where hindsight has replaced process. These reactions are not flaws. They are feedback. The trader who tries to eliminate emotion misses the point entirely. You cannot remove emotion from decision-making in an environment that involves uncertainty and risk. What you can remove is the meaning you attach to outcomes. When outcomes stop being interpreted as personal evaluations, emotional intensity drops naturally. Most emotional pain in trading comes from expectation. Expectation that a setup should work. Expectation that discipline should be rewarded. Expectation that effort should produce predictable results. When those expectations are violated, emotion erupts. Not because the trader is weak, but because the belief structure was never compatible with how markets actually function. Markets operate on probability distributions, not guarantees. Any edge produces a range of outcomes. Losses are not exceptions, they are requirements. Until a trader accepts this emotionally, not just intellectually, the emotional chart will remain volatile. Emotional stability does not come from winning more often. It comes from needing wins less. The trader who requires wins to feel competent will always experience emotional turbulence. The trader who understands that consistency comes from executing a series of trades with a positive expectancy can remain calm regardless of outcome. This calm is not detachment or indifference. It is alignment. It comes from know-I. And G, that each trade is simply one data point in a long sequence. No single trade has the power to define success or failure. When this understanding is internalized, emotional reactions lose their urgency. The real chart becomes smoother. Consider hesitation. Most traders interpret hesitation as lack of confidence or discipline. But hesitation is actually a warning signal. It indicates unresolved conflict between the desire to act and the fear of consequence. That conflict exists because risk has not been fully accepted. The trader wants the opportunity without the possibility of loss. The emotional chart exposes that contradiction instantly. Or consider revenge trading. It is not caused by anger alone. It is caused by the belief that the market owes something after a loss. That belief may never be spoken, but it is clearly visible in behavior. The emotional reaction reveals entitlement, not strategy. Euphoria is equally dangerous. After a series of wins, emotional intensity increases. The trader feels invincible, insightful, special. This state often leads to rule breaking and increased risk. The emotional chart is signaling over-identification with outcome. The trader is no longer trading the edge. They are trading their self-image. Professional traders do not eliminate these emotions. They recognize them early and understand what they represent. Over time, through deliberate practice and consistent exposure, emotional reactions soften. Not because the trader is numb, because beliefs have changed. The turning point occurs when the trader no longer needs the market to confirm anything, when self-worth is no longer on the line, fear has nothing to protect, when identity is no longer tied to being right, losses lose their sting. When expectations are aligned with probability, emotional spikes flatten. At that stage, the emotional chart becomes a quiet background signal rather than a dominant force. The trader can notice emotion without reacting to it. They can acknowledge fear without obeying it. They can experience disappointment without altering behavior. This is the state where execution becomes consistent. It is important to understand that this shift cannot be forced through willpower. Discipline alone cannot override deeply held beliefs. The change happens through awareness and acceptance. By observing emotional reactions without judgment, the trader begins to see the underlying belief patterns clearly. Each reaction becomes an opportunity to realign thinking. Losses become instructional rather than traumatic. Wins become confirmations of process rather than sources of validation. The market becomes a neutral environment rather than an emotional battleground. The real chart no longer swings wildly with every candle. It stabilizes as beliefs align with reality. The trader is no longer reacting to price. They are responding to their plan. This is why the most important work in trading happens away from the screen. Journaling emotional reactions. reviewing behavior rather than results, asking not what the market did, but how the trader interpreted what it did. Over time, patterns emerge, and with those patterns comes understanding. Understanding leads to acceptance. Acceptance leads to consistency. The market will continue to offer uncertainty. That will never change. But the trader's experience of that uncertainty can change completely. When emotional reactions are understood as data rather than obstacles, trading transforms from a struggle into a practice. The chart on the screen shows price. The chart inside shows truth. And the trader who learns to read that chart gains an edge that no indicator can ever provide. Most traders spend years searching for consistency in strategies, indicators, and systems. They change markets, time frames, tools, and rules, believing that consistency is something external, something to be discovered, refined, or unlocked. But the market does not withhold consistency. It simply reflects the trader's internal state back to them. And until the trader is willing to face that reflection, honestly, consistency remains out of reach. Facing the mirror in trading means confronting the parts of yourself that the market exposes. It means seeing fear without blaming the market. It means seeing impulsiveness without justifying it. It means seeing hesitation, overconfidence, frustration, and impatience as internal conditions rather than external problems. This is uncomfortable work, which is why most traders avoid it. It is easier to believe the strategy is flawed than to accept that behavior is inconsistent. The market is uniquely effective at revealing psychological contradictions. A trader may believe they accept risk, but their behavior under pressure reveals otherwise. They may believe they are disciplined, but one unexpected loss exposes emotional reactivity. These moments are not failures. They are mirrors showing exactly where internal alignment breaks down. Consistency does not begin with perfect emotional control. It begins with radical honesty. When a trader stops explaining away mistakes and starts observing them without judgment, learning accelerates. The trader begins to see patterns not in price, but in themselves. The same emotional triggers, the same rationalizations, the same moments where rules are bent or abandoned. These patterns are not random. They are the result of belief structures formed long before trading ever began. Beliefs about money, success, failure, and self-worth all surface in the trading environment. The market applies pressure, and whatever is unresolved rises to the surface. Facing the mirror means accepting that no system can compensate for psychological inconsistency. Even the best edge fails in the hands of a trader who cannot execute it consistently. The mirror shows this clearly. It does not lie. If a trader is honest, the reflection always makes sense. Most traders resist this realization because it removes excuses. Once behavior is acknowledged as the primary variable, there is nowhere to hide. Blaming the market no longer works. Blaming news, manipulation, or bad luck loses its power. Responsibility returns to where it belongs, not as a burden, but as freedom. When responsibility is fully accepted, something shifts. The trader stops trying to force outcomes and starts focusing on process. Instead of asking whether a trade will win, they ask whether it fits their plan. Instead of reacting to losses, they evaluate execution. Instead of chasing emotional relief, they commit to behavioral consistency. This shift does not eliminate uncertainty. It redefines the trader's relationship with it. Uncertainty becomes expected rather than threatening. Losses become normal rather than shocking. The trader stops seeking emotional safety in outcomes and starts finding it in disciplined behavior. Consistency is not the absence of mistakes. It is the ability to respond to mistakes without emotional escalation. The mirror shows this clearly. A consistent trader still experiences fear, doubt, and frustration. The difference is that these experiences no longer dictate behavior. They are acknowledged and allowed to pass. This level of self-mastery requires patience. Old habits do not dissolve quickly. Beliefs formed over years do not disappear after a few insights. Facing the mirror is not a single event. It is an ongoing practice. Each trading day presents new opportunities to observe internal reactions and adjust behavior accordingly. One of the most powerful realizations a trader can have is that consistency is a byproduct, not a goal. It emerges naturally when internal conflict is resolved. When a trader no longer argues with the market, fights uncertainty, or resists losses, behavior stabilizes. The mirror becomes less dramatic over time. Emotional reactions soften, impulses lose urgency, Decisions become quieter and more deliberate. This is not because the trader has become indifferent, but because they have become aligned. Alignment means that expectations match reality. The trader expects losses, they expect uncertainty, they expect variability. Because of this, nothing the market does feels personal. Without personal interpretation, emotional intensity drops. Without emotional intensity, execution becomes reliable. Facing the mirror also means accepting imperfection. No trader executes flawlessly. The goal is not perfection, but consistency of intent. Each trade is an opportunity to reinforce disciplined behavior, regardless of outcome. Over time, these small acts of consistency compound. Many traders mistake confidence for certainty. True confidence comes from knowing you can follow your rules under pressure. That confidence is earned by repeatedly facing uncomfortable moments without avoidance. Each time the trader chooses discipline over impulse, trust in self increases. The market continues to test this trust. It will produce losing Saint reeks. It will produce unexpected moves. It will challenge patience. These moments are not setbacks, they are invitations to reinforce alignment. The mirror is asking the same question repeatedly. Will you remain consistent when the outcome is uncertain? The trader who answers yes over and over again begins to experience stability, not because the market has changed, but because their relationship with it has. Trading becomes less emotional and more procedural. Decisions become less reactive and more intentional. Facing the mirror also dissolves the need for external validation. The trader no longer measures success by profit alone. Success is defined by adherence to process. This redefinition removes pressure and creates psychological space. In that space, clarity emerges. Clarity leads to simplicity. The trader stops overanalyzing, they stop second-guessing, they stop looking for confirmation beyond their plan. They see opportunities clearly and act decisively. Consistency follows naturally. Ultimately, facing the mirror is an act of courage. It requires acknowledging uncomfortable truths and releasing familiar defenses. But the reward is profound. The trader gains control over their behavior in an environment where outcomes cannot be controlled. That is the paradox of trading. You achieve consistency not by mastering the market, but by mastering your responses to it. The mirror shows you this truth every day. And when you finally stop looking away, consistency stops being something you chase and becomes something you embody. The market will always reflect who you are before it rewards what you know. When you stop fighting that reflection and start learning from it, consistency becomes inevitable. Trading is not about controlling outcomes, eliminating emotion, or predicting the next move. It is about aligning your beliefs with uncertainty and executing your plan without resistance. Face the mirror honestly, accept what it reveals, and commit to disciplined behavior. When your actions remain steady, regardless of outcome, the market stops feeling chaotic, and consistency becomes your natural state.